What happens when the same ounce of silver carries two very different prices in two major parts of the world? That question is becoming impossible to ignore as China's silver market approaches a clear tipping point. In early February 2026, price spreads between the Chinese domestic market and Western benchmarks, such as COMEX, widened sharply to $10, $20 per ounce. This is not normal arbitrage noise. It is a warning signal. When physical silver in China consistently trades at a double-digit premium, it exposes a growing disconnect between paper-based pricing in the West and real, deliverable demand in the East. China is not a marginal buyer. It is the world's largest consumer of industrial metals and one of the largest accumulators of precious metals. Unlike Western markets where silver exposure is dominated by futures, ETFs, and leveraged derivatives, China's demand is heavily skewed toward physical settlement. Historically, similar price divergences have appeared just before periods of forced repricing, when futures markets could no longer suppress physical scarcity. The spread itself becomes evidence of stress inside the system. This is exactly the kind of early signal most investors miss by focusing only on charts. Welcome to GB Economy, where we deliver in-depth analysis of economics, finance, and the underlying rules that govern markets. If you find value in this content, don't forget to hit the like button to support the channel and subscribe to GB Economy to receive more high-quality insights. That widening price gap would be concerning on its own, but what comes next explains why it is happening. The divergence between China and the West is being driven by a rapid and measurable drawdown of physical silver inside China itself. On the 6th of February, 2026, official data showed that silver inventories held in the vaults of the Shanghai Futures Exchange collapsed to 349.9 metric tons. What makes this number alarming is not just the level, but the speed. In a single trading day, inventories fell by 62.6 tons, the largest one-day decline on record. To put that in context, this amount represents a significant share of exchange-registered silver disappearing almost overnight. Such moves do not occur in stable markets. This depletion followed a sharp 15% price crash, an event severe enough to trigger emergency responses from the exchange, including higher margin requirements and tighter trading limits. These measures are typically used to suppress volatility, but historically, they also appear when physical supply is under strain and paper positions begin to lose credibility. The timing matters. A price collapse should, in theory, reduce demand and stabilize inventories. Instead, inventories accelerated lower. That contradiction tells us the selling pressure was largely paper-based, while physical buyers stepped in aggressively to remove metal from the system. When prices fall but inventories vanish, the signal is unmistakable. Silver is being taken, not traded. This rapid drawdown transforms the earlier price divergence into something more serious, a tangible supply shock. And once physical stocks reach critical levels, futures pricing loses its ability to dictate reality. The market stops listening to paper and starts responding to scarcity. The rapid drawdown in silver inventories would already be a red flag, but the picture becomes even more revealing when we examine how China reports data across precious metals. While silver stock levels at the Shanghai Futures Exchange are published and show extreme volatility, the situation with gold is far less transparent. The Shanghai Gold Exchange does not publicly release vault data for gold at all, leaving a critical gap in visibility within the world's largest precious metals market. The only available reference point comes from SHFE disclosures, where reported gold inventories have remained remarkably stable, hovering around 104 metric tons, with almost no net change over recent months. This stability stands in sharp contrast to silver, which saw inventories collapse by more than 60 tons in a single day in early February 2026. Under normal market stress, pressure tends to appear across related assets. Seeing silver drain rapidly while gold data remains static or entirely undisclosed raises uncomfortable questions. Selective transparency is rarely accidental. Historically, limited disclosure often coincides with periods of physical strain, when revealing full data could expose deeper imbalances. In this case, silver may be the only market where stress is visible, while gold remains shielded from scrutiny. For investors, that asymmetry suggests the pressure in China's precious metals complex may be broader and more intense than official numbers currently admit. That imbalance in transparency makes more sense once we look at how silver is actually used and traded on each side of the world. In China, silver demand is overwhelmingly physical. Industrial users, refiners, and institutional buyers focus on metal that can be delivered, stored, and consumed. This is reflected in the way inventories move. When prices fall, physical buying accelerates, and silver is withdrawn from exchange vaults. That is exactly what we saw in early February 2026, when tens of tons disappeared from registered stocks in a matter of days. The Western market operates very differently. In the United States and Europe, silver exposure is dominated by paper instruments, futures contracts, options, and exchange-traded funds. On venues such as the Chicago Mercantile Exchange, the notional volume of silver traded each day represents multiples of annual mine supply, even though only a tiny fraction ever results in physical delivery. Various industry studies estimate that the ratio of paper claims to physical silver in Western markets can exceed 100 to 1 during periods of heavy speculation. This structural difference matters. Paper markets are efficient at setting prices, but poor at reflecting scarcity. Physical markets do the opposite. When China pulls metal out of the system while the West continues to trade contracts, price signals become distorted. Eventually, the side demanding delivery, not exposure, forces reality back into the pricing mechanism. That structural divide between physical demand in China and paper trading in the West becomes even more dangerous when concentrated leverage enters the picture. In this case, the stress has been amplified by reports that a Chinese billionaire accumulated an unusually large, naked short position equivalent to roughly 450 metric tons of silver, a volume large enough to distort price behavior in a market as thin as silver. To put that in perspective, this position represents a meaningful share of exchange-registered inventories and far exceeds normal speculative exposure. In early February 2026, Chinese and Hong Kong media began reporting that tax authorities may formally investigate this trader, raising the possibility that the position could be forced to unwind. That timing matters. These reports surfaced just as silver prices rebounded sharply after a 15% crash, and as physical inventories were draining at record speed. When a large short exists in a tightening physical market, the risk profile changes completely. If such a position is closed under regulatory or financial pressure, the buying required to cover it would not occur gradually. It would be compressed into a short time window, potentially triggering a classic short squeeze. In silver, where liquidity is limited and physical availability is shrinking, that kind of forced buying can overwhelm price controls. History shows that squeezes do not move prices incrementally, they reprice markets violently. In this environment, one large short is no longer just a bet. It is a systemic risk. With physical stocks tightening and leveraged positions under scrutiny, the near-term outlook for silver becomes increasingly unstable. Several market analysts now suggest that prices could remain range-bound between $65 and $85 per ounce in the short term, reflecting a temporary balance between paper selling pressure and strong physical buying. This kind of wide trading range is typical in thin markets like silver, especially following sharp moves such as the 15% price drop seen in late January 2026. However, this apparent stability is fragile. If regulatory pressure in China forces the closure of large short positions, particularly those tied to hundreds of tons of notional silver, the market could reprice rapidly. In that scenario, the move would not be gradual. A short squeeze in a physically constrained market has the potential to push prices beyond $100 per ounce, not because of speculation, but because supply would simply be unavailable at lower levels. Silver's history shows that long periods of compression often precede sudden expansion. What looks like sideways movement today may, in reality, be the calm before a much sharper adjustment. What turns a volatile market into a global problem is scale, and China operates at a scale no other participant can match. As the world's largest consumer of gold and silver, China's behavior does not stay local for long. When physical silver is withdrawn from Chinese exchanges at the pace seen in early February 2026, tens of tons in a matter of days, it does not simply tighten domestic supply. It begins to strain the entire global flow of available metal. Silver is not an easily expandable market. Annual mine supply grows slowly, recycling is price sensitive, and above-ground inventories are far smaller than most investors assume. If China continues removing physical silver while simultaneously paying premiums of $10, $20 per ounce, that metal must come from somewhere. Historically, similar episodes have forced exporters and refiners in other regions to redirect supply toward Asia, leaving Western markets increasingly dependent on paper settlement rather than delivery. At the same time, policy signals suggest China is unlikely to alleviate this pressure. During periods of strategic accumulation, Beijing has often favored restricting exports while increasing imports of critical commodities. If that pattern repeats with silver, the result is straightforward: less metal available globally, just as physical demand intensifies. Once supply chains tighten at this level, price becomes secondary to availability. And when availability disappears, Markets don't adjust smoothly, they reprice abruptly. The picture that emerges from these developments is clear. The current price of silver does not fully reflect the pressure building in the physical market. When inventories can fall by more than 60 tons in a single day, when Chinese buyers consistently pay $10, $20 per ounce above Western benchmarks, and when large short positions face the risk of forced closure, price becomes a lagging indicator rather than a leading one. Volatility, therefore, is not a temporary condition. It is the market's natural response to unresolved structural stress. Silver has always been a smaller, more fragile market than gold, and that fragility amplifies every imbalance. As physical supply tightens and paper mechanisms struggle to contain it, sharp swings should be expected rather than feared. What matters is not the noise, but the direction of underlying pressure. Thank you for watching this video. If you see these signals differently, or if you believe the market will resolve this tension another way, share your perspective in the comments below. Your insight adds depth to the discussion and helps us all better understand what may come next.